Keep watching to learn more about Grantor's Retained Annuity Trust, GRATs, and Grantor Retained Unitrust, GRUT. First, let's go over Grantor Retained Annuity Trust. A Grantor Retained Annuity Trust, GRAT, is an irrevocable trust into which a grantor makes one-time transfer of property, and which the grantor retains the right to receive a fixed amount in annuity at least annually for a specified term of years. At the end of the retained annuity period, the property remaining in the trust passes to the remainder beneficiaries or remains in the trust for their benefit. A transfer of property to an irrevocable trust is a taxable gift. The value of the gift on which federal gift and estate tax is imposed is generally its fair market value. However, because the grantor retains an interest in a GRAT, the value of the transfer is discounted. Transfer tax is imposed only on the remainder interest. Note, any transfer tax due may be sheltered by the grantor's lifetime gift and estate tax applicable exclusion amount. The taxable value is calculated using interest rate provided by the IRS, known as the discount rate or Section 7520 rate, which is based on the current interest rates and changes monthly. This interest rate assumes the GRAT property will earn certain rate of return during the annuity period. Any actual return that exceeds the assumed return passes to the remainder beneficiaries transfer tax-free. Investment performance, therefore, is central to the strategy. A Grantor Retained Annuity Trust allows the value of the property transferred to the trust to be discounted while removing the trust property from the grantor's gross estate. For GRAT to be successful, the grantor must outlive the term of years, the GRAT property must outperform Section 7520 rate, and the GRAT document must be properly drafted. The potential tax advantage of GRAT. Because of the retained interest, the value of the transfer for federal gift and estate tax purposes may be discounted. Principal remaining in the GRAT at the end of the term of years is removed from the grantor's gross estate for federal gift and estate tax purposes. Interest, that is appreciation and/or earnings, remaining in the GRAT at the end of the term of years passes to the remainder beneficiaries, federal gift and estate tax free. There are some key trade-offs. If the GRAT properly underperforms Section 7520 rate, no tax savings is achieved, and if the GRAT is depleted, no property is transferred to the remainder beneficiaries. If the GRAT property underperforms Section 7520 rate, gift taxes paid and/or any applicable exclusion amounts used will be wasted, although the amounts would be minimal. If the grantor does not outlive the terms of years, any property remaining in the GRAT is includable in the grantor's gross estate for federal gift and estate tax purposes. If the GRAT is unsuccessful, any cost incurred to create and maintain the GRAT will have been wasted. To implement a GRAT, you must have someone helping you with that. Feel free to contact us if you want some more information on that. You also must have a property that is transferred to GRAT professionally appraised. Transfer property to GRATs, i.e. retail assets, and file gift tax return. Now let's go over Grantor's Retained Unitrust, GRUTs. A Grantor Retained Unitrust is an irrevocable trust into which a grantor makes one-time transfer of property and which the grantor retains the right to receive a variable amount based on fixed percentage of trust assets valued annually, at least annually for a specified terms of years. At the end of the retained unitrust period, the property remaining in the trust passes to the remainder beneficiaries or remains in the trust for their benefits. A transfer of property to an irrevocable trust is a taxable gift. The value of the gift on which federal gift and estate tax is imposed is generally its fair market value. However, because the grantor retains an interest in a GRUT, the value of the transfer is discounted. Transfer tax is imposed only on the remainder interest. A Grantor Retained Unitrust allows the discount for the value of the property transferred to the trust, while removing the property from the grantor's gross estate at the same time. Note, any transfer tax due may be sheltered by a grantor's lifetime gift and estate tax applicable exclusion amount, which is $12,060,000 in 2022 and $11,700,000 in 2021. The taxable value is calculated based on the value of the property transferred to the GRUT, the unit trust payout rate, the term of the trust, and using interest rate provided by the IRS, known as the discount rate or Section 7520 rate, which is based on current interest rates and changes monthly. However, unlike with a GRAT, Section 7520 rate has little or no effect on the value of the remainder interest in a GRUT. A GRUT is the same type of trust as a Grantor's Retained Annuity Trust, except that with a GRAT, the grantor receives fixed annuity amount rather than a variable unit trust payment. Because of this, payments to the grantor of a GRUT may increase or decrease each year depending on the value of the trust assets. And because the unit trust payments must be recalculated each year, the cost to administer a GRUT may be greater than a GRAT. Another important difference between these two trusts is that unlike GRAT, GRUT can be zeroed out and therefore a taxable gift always results. For GRUT to be successful, the grantor must outlive the term of years and the GRUT document must be properly drafted. Potential tax advantages of a GRUT. Because of the retained interest, the value of the transfer for the federal and estate tax purpose may be discounted. Principal remaining in the GRUT at the end of term of years is removed from the grantor's gross estate for federal gift and estate tax purposes. While not a tax advantage, if the value of the trust properly increases, payments to the grantor increases, possibly providing a protection against inflation. There are some key trade-offs. If the GRUT property performs poorly or is depleted, there may be a less than anticipated transfer to the remainder beneficiaries and little or no tax savings and gift taxes paid and or any applicable exclusion amounts used may be wasted. If the grantor does not outlive the term of years, any property remaining in the GRUT is includable in the grantor's gross estate for federal gift and estate tax purposes. If the GRUT is unsuccessful, any cost incurred to create and maintain the GRUT will be wasted. If the value of the trust property decreases, payments to the grantors decrease and may not provide enough income. If payments to the grantors increases because the value of the trust property increases, the additional payments will be included in the grantor's gross estate for federal tax purposes unless consumed or given away. To implement, feel free to reach out to us and we'll give you some guidance. You must have a property that is transferred to the GRUT professionally appraised. Also, transfer property to a GRUT that is retitled asset and file gift tax return. It is worth noting that Grantor's Retained Annuity Trust or Grantor's Retained Unitrust could be possible solutions in business succession planning. I have a video that goes further into that. The link is in the description. And always, feel free to reach out if you have any questions. Our contact information is also in the description.